It is much easier to buy low than it is to sell high, because crypto prices tend to be at the lower end for much longer than they tend to be elevated. We see very quick rallies, we see high prices, and then those prices deflate very quickly. So that's simply because of the time horizon. It's easier to buy low than it is to sell high. The second problem is that once we have bought low, and once we have that rally, the multiple X returns, that the amount that we have to sell for are much higher compared to the amounts that we bought for. So let's say we buy $1,000 every month. We do this for a long period, 2 or 3 years. Then we get the 3-4x returns. Now we have to sell in a much shorter time period for much higher amounts. So maybe we only have, say, a few months, say 3 or 4 months to sell after a 4x. And we had several years to buy beforehand. So the amounts that we have to sell for are 10, 20, 30, 40 times larger. This is Bitcoin's long-term price chart. And if you dollar cost average into Bitcoin, you have got a long time. Maybe this is 30 months or so. You stop buying after the rally accelerates. You then make the real returns, right? The 10, 20x returns. And then after 30 months at a 10x, you have 300 times your regular purchase amount. So instead of buying for $1,000 every month, suddenly you have to sell for $100,000 over the course of 3 months. And this repeats all the time. And this is why so many people do not sell enough, and while they ride through the bear markets, while they actually do have a lot of their capital still in crypto, when things go down by 70 or 80%. The big question is, where are we now? This support is now close to 50K, by the way. It's also to identify the times when we are very low compared to when we are high. It's much harder to figure out when a rally stops than to figure out when we are very low in the bear market. This is the Bitcoin Coindays net value transfer and realized value transfer ratio. The net value transfer fluctuates much more, so looking at the realized price is a bit cleaner of an indicator. And we should be buying when this is high. We should rather sell when this is low. Currently we are rather low, so it might be still very early to buy this dip. Instead of looking at the realized price of the entire market, we can just isolate the long-term holders. It's not that much of a difference. Still, it tells us that the market is currently not yet that depressed. A similar picture to when we just look at this long-term growth line of Bitcoin's price development. This is a logarithmic chart, by the way. The reason for the price decline from 120K to the current levels is the long-term holders selling. They're selling already for quite a while. And the big question is, when will they stop selling? Because that's probably when we might see at least an intermediate turnaround. The long-term holder spending, so the area here in blue, is currently at record low levels. And this is always when the rally tends to stop, right? When the long-term holders offload their holding, that's when it's hard to see further price appreciation. The ETFs have barely any impact on the price. It's really the long-term holders that dictate when things stop rallying or when we see a potential bottom. Currently, we still see the long-term holders selling, and that's the big problem. The Bitcoin value days destroyed multiple has also peaked. It hasn't gotten green for a while. And we want to be green for a bit, or in other words, the long-term holders not moving their dormant Bitcoin anymore to see new price increases. By the way, if you so far enjoy this content and you don't want to miss future videos, then feel free to subscribe. I publish videos regularly over here. Here's a bit more of a volatile indicator, the Bitcoin Coindays destroyed without any smoothing, which does show that we might see a bit of a reduction in selling, but we're already going down in the price since we just hit levels above 1 in this indicator. So it's very hard to say how much lower we are going with the long-term holder Coindays destroyed. If we stay between 1 or 2 and we don't really fall to bottom levels, Bitcoin can very easily drop further. We always have to ask ourselves, who is the marginal buyer in a market? If the Bitcoin price is very low, when it's now, say, going down to 30 or 40K per BTC, it might make sense to take a contrarian bet, right? Because when Bitcoin is at 30K, there is the potential for it to potentially 5x relatively soon. But if we are at 90k or at 80k, a 5x in the short term is very unlikely. And so that's a risk to reward everybody has to play with. Does it make sense to make a contrarian bet when we currently tend to rather go down, when the upside is limited, but when there's still quite a bit of downside, where you could easily fall 50% from here? Here's the Bitcoin reserve risk, also an indicator that tended to work pretty well. Both the bottoms as well as the tops tend to decline in magnitude, but again, we are not yet anywhere close to the blue buying zone. There's another interesting indicator, I like it a lot. It's the CBBI. It's a combined metric of several indicators. We've got the Pi cycle top indicator, that's a momentum indicator. We've got the realized and unrealized profit and loss. So that looks at the reference price of the market, right? When people are currently in net unrealized losses, but they do believe in Bitcoin long term, they might hold on, they might not sell, but when they're in profit, they might take the profit. You've got the realized hodl ratio. This is how much short-term speculation there currently is. The Puel multiple, it's a mining profitability indicator. We've got another momentum indicator, the 2-year moving average. We've got a trading range indicator, the Trololo trend line. So this is a logarithmic regression. Market value to realized value z-score. How much are we currently in profit relative to the volatility? How much the price is fluctuating? We've got the reserve risk, and we've got the Wubull top cap versus coin value days destroyed, right? We looked at the value days destroyed just a second ago. I like this indicator a lot because it encompasses several aspects of the market. It goes between 100 and 0. It tended to be a very good top and bottom indicator. Currently, we are at close to 60. So the market is still above average expensive, right? We are not at the 50 mark, which is the historical neutral point. And so if my thesis is correct, if it's really the long-term holders that are currently taking profit and that are depressing the market right now, then the only real question is, when are they going to stop selling? And if everybody thinks now that 2026 will be a bearish year, the long-term holders selling because of that, then maybe the selling will stop once they are in losses as well, because then it's not anymore about profit taking, then it's about just panic selling. This is the long-term holder average cost basis. So that's the line in blue, and currently the long-term holders bought on average for $36,000. Historically, at the end of the bear market, we did fall below that cost basis. We also briefly hit it during COVID. And so in the worst case, this is what we are facing, right? This is the potential risk. What's the reward? Maybe Bitcoin can hit 150K. What's the risk? It could go down to below 36K. So is it really worth the risk to get massive Bitcoin exposure if that's the potential negative scenario? I'm also looking at capital flows, right? I want to see how money goes from traditional finance into the crypto ecosystem. If people still transfer their fiat currency into stablecoins, they convert this via custodians into stablecoins, and the stablecoin market cap continues to go up, that's potentially positive. We have seen the stablecoin market cap increase since October of 2023, so for more than 2 years now. But recently, in the last few weeks, that growth has stopped. So for a bit over 1 month, we haven't seen the stablecoin supply growing anymore. Now, if it continues to grow again, then great. Maybe we see another leg up, at least temporarily. But if that continues to go sideways, there's always a risk of something potentially systemic even blowing up, as we saw with Terra Luna and then subsequently FTX. That's always what we potentially face. Crypto is still seen very much as a risk on asset class. It has a lot of volatility, and to justify that risk, to justify the volatility with an investment, we need to have high expected returns. And those high expected returns can only come from low valuations after Bitcoin has already crashed, or they can come from stablecoin inflows, from capital still getting into the market, from positive momentum. Currently, both of those factors look problematic, right? We don't have money coming in and we don't have positive momentum, and prices are not very low, historically speaking. Now, this whole game can be as complex or as simple as we want. We can just dollar cost average into the market, just bet on long-term adoption, bet on long-term devaluation of money, and we are fine. We don't necessarily have to time the market. Alternatively, we can make it very complex, as in we try to follow every single piece of news. We try to get an edge by being more informed than the average market participant. I think the best is a middle ground, trying to still time the market, but not just based on guesswork, based on mathematical approaches that used to work pretty well in the past. And so this is my favorite approach. It's following a technical indicator, the moving average, that historically worked the best. What we see over here, that's the 44-day simple moving average. And the strategy is very straightforward. We go long, we bet on rising prices whenever we are above that moving average, and we bet on falling prices whenever we are below that moving average. Now I've backtested all moving averages from the 2-day to the 200-day, and the 44-day is one of the best. And historically, this worked very well. Will it work in the future? Who knows? But at least over the last 10 years, it performed much better compared to just buying and holding. Buying and holding is the line here in white. Every horizontal line here, by the way, that's a 10x return. So this performance is more than 100x better than just buying and holding Bitcoin. Here's the same performance measured in BTC. And so that's then the potential alternative to just dollar cost averaging into Bitcoin, trying to ride the market. Now you can simply trade this yourself, right? You can just buy and sell whenever you are above or below the 44-day simple moving average. Or if you wanted to, you can also allocate towards that strategy directly. So that's part of the premium membership of this channel. The link is down below. It's thebitcoinstrader.com. A link to premium pops up here on the screen. It will lead you to the website. Thanks again for watching and see you next time. Cheers.